Okay, so our third form of business obviously is corporations. This is what most people think of when they think of business. Um, and quite honestly, when people think of starting their own business, I know when I was younger, it was my thought process was if I'm going to have my own business, it's got to be huge. It's got to be the next Walmart and things like that. And part of it, folks, you got to understand. Uh, Most corporations didn't start like that. Walmart didn't start as a nationwide company. It started as Walton's Five and Dime in Bentonville, Arkansas, and you look at Amazon with Bezos. It wasn't the company it was now when it started. He started it in his garage at his house. So, but when we hear business, we hear corporations. That's what we think about. So we spend, quite honestly, most of our time talking about that, and that's what this class is about. Okay. The advantages, obviously, limited liability, unlimited life. When you start a corporation, you get a federal employer identification number, an FEIN number, and basically, once you get that, it's almost like you have a living, breathing person. You create an entity, right? When we talk about the limited liability, think about sole proprietorships and partnerships. If you putting the capital together for businesses to start up, people to get into business. If your business is $500,000, it's a lot easier to find 500 people that are willing to part with $1,000, because if they lose 1,000, they aren't worried about paying their mortgage or putting food on the table or clothes on the back of their children, right? But versus one person that has $500,000. And if you lose that 500,000, now you got other issues to worry about. What about the house? What about feeding the family and things like that, right? So the limited liability is just what you put in when you buy the stock, whether it's $1,000, 10,000, or whatever. Okay. The other thing is you have separation of ownership and management. Um, Quite honestly, when you get into business, a lot of times one of the things that hurts small businesses, especially mom and pop things, is you hear the fact that most people get into it because they love what they're doing, they enjoy it, and they want to figure out a way to make that a living from doing what they enjoy. The problem with that is when you start doing that, a lot of times you get sucked into this situation where you spend more time working in the business, being hands-on, doing all the stuff, rather than working on the business, managing it, overseeing what's going on, and seeing it from a broader picture. And quite honestly, that's what dooms a lot of small businesses, right? Um, so when you have that separation of ownership and management, you got the one hand that's in there doing everything and involved in the day to day, and you got the other side that's kind of looking at the broader picture and seeing what's happening there. When it comes to transfer of ownership, quite honestly, you just sell your stock. It's that easy. Hey, I don't want to be a part of this anymore. You don't have to worry about partners, or anything like that. Um, easier to raise capital. We already talked a little bit about that. It's easier to find a lot of people with a little bit of money than one person with a lot of money that's willing to part with it and believe in your vision. Okay. The disadvantage of a corporation is this double taxation. First off, the corporation pays taxes, and we'll get into this in the next chapter when we talk about income statements and balance sheets. And then obviously, that corporation has net income. That net income then goes to retained earnings and dividends. When the dividends are paid out to the stockholders, who are the owners of the company, then if they're taking it as income, then obviously they're going to pay income taxes on that money. Okay. Now, when we talk about separation of owners and management. So now we got to look at what's going on there and what should the goal of our corporation be. And this is kind of where we get into some issues. Do we want to maximize profit? Well, that's what we got into business for, is to make money, right? But if we just maximize profit, are we talking about accounting income? Are we talking about cash flows? Because quite honestly, in finance, we're worried about cash flows. Do we have more money coming in than what's going out? So what are we looking at there? Do we look at minimizing costs? Well, that might not be the best thing, because yes, we want to minimize costs because that helps us to maximize our profit and gives us a bigger profit margin. But the problem with that is, you can take little steps incrementally to save money. Maybe you're getting a little cheaper product. You could see this in a restaurant or something. If you look at just think of a pizza company. If you have pizza and hey, we ordered a certain type of pepperoni and it's cut, so thick. Well, if we want to cut costs, now we shave that pepperoni a little thinner and we get more pieces of pepperoni. Well, that's fine, but what happens to the quality of the pizza? And what happens to your customer's perception of the quality of the pizza as you do that? And if you make one little step, that might not be a bad thing, or it might not be noticeable, but then if you make it over and over again, eventually you're so far from your original product that you've lost sight of where you were and maybe lost that quality, right? If we look at maximizing market share, man, that sounds great. Hey, we own the market, or we have a big chunk of the market, but how did we get there? Well, we lowered our price. Well, that's good. Are we making money on it? Well, doesn't matter. We have market share. No, that's not the same. We got to worry about being able to make money. And even though we have the market share, if it's not profitable, you're not going to be there long. All you have to look at are the dot-coms of the late 90s. When they had the Super Bowls, it was .com this, .com that. Every commercial was .com. And all they were doing was they were throwing money at advertising to get people to go to their site, to get hits on their site, and they were hoping some of them enough stuck that the company would be profitable, and that's just not what happened. Okay. Then the other question here is maximize the current value of the company's stock. Okay. If we look at that, when we maximize the current value of the stock, if we do that, then the people who own the stock are the company owners. So we're kind of maximizing the owner's wealth, if you want to look at it that way. Now, it's maximizing the value of the stock the goal, or should it be the ultimate goal? Well, that would be maximizing your owner's wealth. That's a pretty lofty goal. When it comes to doing that, what goes into maximizing the value of the share of stock? Well, that's a little bit of all of those other questions. We want to have the market share, but we want to have profitable market share. We want to minimize costs, but be able to maintain quality, and we want to maximize those profits. How do we do that? Well, it comes through operations. Do we need to, going back to our capital budget, hey, our plant's been open for a long time. Maybe we have a machine that is a little defective and it's producing product that we got to throw out 5% of our product because it's defective. Well, maybe maximizing our wealth is, let's buy a new machine where we don't have that loss of product. Okay. So I think maximizing your company's stock, that's taking more of a long-term approach view of it than just short-term. Okay. The other thing that we get into is the situation of what we call an agency problem. Because think about it. We have separation of owners and stock, or management, I'm sorry. And quite honestly, folks, I'm just going to tell you straight up. Nobody, if you have a sole proprietorship, a partnership, even if you have a small S corp, um, nobody is going to care for your business as much as the person who has skin in the game. We look at these large corporations and we think, wow, I own 10 shares of that stock and that stock cost me $10. I got $100 in that. You're not going to look at that company as much as the person, the mom and pop who in town, who that's their sole source of income, and maybe they leverage their house to be able to get into that business. Those folks are going to be laser focused on that business. Okay. Now, when we look at the agency problem, the owners hire managers. Okay. So the stockholders hire the managers to run the company. What can happen here is you're going to pay these people money. They have a board of directors, yes. But the thing with the board of directors is generally what happens if you got people who aren't used to making decisions that involve hundreds of millions of dollars or billions of dollars. You just can't pull somebody off the street and make those types of decisions, right? So that the pool of people who understand that is fairly small. So usually what happens is somebody's on the board of one company, they're probably on the board of another, and maybe they're the CEO of a third company or whatever. So they're on each other's boards. They want to have board meetings. Well, the weather can be bad or whatever. Maybe we don't have board meetings in Boone in the middle of winter. We'd much rather have board meetings in the summer at the coast or something like that. So the board votes on that, and of course they're going to say yes because they're the ones going to the meeting. When we look at comes to raises and things like that, hey, the board, if I'm the CEO and you folks, my classmates, or the class is my board of directors, and I want a raise, and I talk to you folks about it and you vote it, generally you're going to vote me a raise, right? Well, then when you have your meeting and I'm on your board, well, if you voted for my raise, then chances are I'm going to vote for your raise. Okay, so you have that issue there. The other thing is, how do we know, that they're working in our best interest all the time? A lot of times we got to we got to monitor that. So we have agencies come in. So not only do we have the cost of the management, what they're doing with the company, we have the cost of somebody like KPMG or another company that comes in and audits them and makes sure they're doing what we want them to do in the way we want them to do it. And that's cost effective. Okay. A good example of that. Hopefully you guys remember this. You might not, but there was a company called Enron. Everybody thought it was a magnificent company, running great, making money hand over fist. Everybody was thrilled with it. They had an audit come to find out all it was a big Ponzi scheme. The new investors, they needed to bring in new investors to pay the investors that had been there a while. And so once that was realized, the whole thing fell apart. So that's a big problem with corporations. Okay. We talk about managerial compensation. Think about it. Incentives, we can align incentives to stockholder interest, right? You want to achieve their goal, but one of the things I love to hear, you guys might not remember Michael Eisner. He was the CEO of Disney back in the 90s, and at one point his compensation was $50 million a year. Was he worth it? I guess. Disney's one of the largest companies. They own ABC, ESPN, they own Fox now. But really, when you look at CEOs here and CEOs in Europe generally make 500 to maybe $1 million or $2 million a year versus CEOs here who are in the tens of millions of dollars a year, right? We also look at incentives. And this is kind of interesting. When we look at incentives, look at Apple. Steve Jobs was running Apple. He ran it for a number of years. Then he decided to retire. Apple's stock went down. They started doing multiple products and stuff. They asked Steve Jobs, he was sick, come back, take control. And he looked and he said, wow, we got 340 products. He said, cut all that. We're going to focus on 14 products. So he got their focus back to just a few products. Everybody was thrilled. The company went back up and everybody's like, look, Steve Jobs is only working for $1. His salary was supposedly $1 a year. And folks, if you believe that, I got a bridge out in Arizona with some or oceanfront property out in Arizona, as the song goes, right? They paid him in stock. And so think about this. If he was given 1 million shares of stock that were valued at $100 a share, then he could take, and he raised that stock price from $100 to $120, then he could take that stock and sell it if he wanted to. And that was his incentive plan. So he went from maybe 100 million and I know that's a large number, but maybe from 100 to $120 million. But that's the type of stuff that's going on. So when you hear things like that, folks, please look into the background and see what's really going on and how they're being compensated. Okay. The other thing you have is threat of corporate takeover. There's a couple of good examples of that. All you have to look at there is Men's Warehouse. They wanted to merge with Joseph A. Bank. And if you remember, the original owner of the company had the beard and mustache. You're going to love the way you look, I guarantee it. He didn't want to do that. He said this was his company and he wanted to stand alone. Well, the board ended up kicking him out so they could merge, and the merger still didn't take effect. And so, he's out of his company. They took it over from him. The other is Papa John's. You look at what happened there. Papa John's had some comments he made out in the public. The board didn't like them, thought they hurt the company's sales, so they ousted him, and they're still kind of dealing with that. Okay. The other thing you got to think about is, other stakeholders that are involved in the company. You got large investment firms, you got companies that maybe the banks that you borrowed money from, and things like that. Okay, so those are some of the issues that you have with corporations. Not to say that corporations are bad. Corporations do a lot of good stuff, but that's what you have when you have a separation of ownership and management, and that's probably the biggest thing to deal with. Okay. All right. Next, we're going to talk about the financial markets, and we'll do that in the next video.